The US is not moderately overpriced. It is shockingly overpriced. I think they'll do pretty well by selling.
Whatever you do, get rid of this fear of missing out, this terrible lust to participate in profit making that comes along at the end of every one of the great bubbles. It is incredibly seductive, very hard to resist. Been there, done that myself a few decades ago, made a fortune and wiped myself out. Very salutary. And I would wish on most of you that you avoid it.
Jeremy Grantham is a billionaire investor and one of the most closely followed voices in all of Wall Street. He is the co-founder and chief investment strategist of GMO, an investment firm with well over $100 billion in assets. Grantham has never been afraid to speak his mind when it comes to calling a bubble, having successfully called the tech bubble of the early 2000s and a great financial crisis in 2007 and 2008. Now, Grantham is warning that these prior bubbles pale in comparison to what's happening currently in real estate markets across the world. Here's what he had to say.
Nothing is certain in life, but I would say that is the beginning of the burst, when the specs that typically go up quite a lot more than the market go down as the market goes up. So the S&P went up 25% last year, and a lot of the most speculative stocks were already going down. That is very rare. It happened in 1929. It happened in 1972 before the very big decline then. It happened in 2000 before the tech wipeout.
So you're saying we are at the beginning of a crash?
I would say it is likely that we are. I think it would be unlikely that the market would not come down by 50% from its peak. The broad market, the S&P, and it would be unusual if the specs did not do worse than that. The problem is it slow or is it quick? The stimulus program left a lot of money in individual hands for buying the dip, and they have been throwing money this year, individuals, at the dips. They have probably never invested more rapidly than they have this year, and despite that, of course, the market is down. But they have a lot of money. They're pretty well funded. Many corporations are doing well. The economy isn't too bad. So this could turn out to be quite a struggle, where slowly but surely the market has to readjust to higher and higher rates and higher inflation. It will not give up, I suspect, too easily, but will fight it out. If you look at the real estate market, all real estate markets pretty well around the world are very, very high. And if you look at the bond market, of course, interest rates are incredibly low and bonds are incredibly high. But when it comes to the stock market, rather like 2000 and the tech bubble, this is more an American affair than anything else. Outside America, the world is merely overpriced. Ho-hum. It's often overpriced. It's usually not that dangerous. In the US, however, we have an extreme overpricing, extreme crazy behavior, and I think we're in a rather dangerous equity bubble. So there is a decent chance that Australia, the UK, Japan, there's some fairly reasonably priced countries. If they come down in sympathy, they'll come down a lot less and probably rally earlier.
Jeremy Grantham highlights the risks of an overheated U.S. market, but the bigger issue lies in our collective tendency to chase speculative gains driven by the fear of missing out. This psychological cycle has repeated itself through history, from the 1929 crash to the dot-com bubble of 2000. Grantham's warning is clear: the signs of an impending market correction are visible, yet most investors remain blinded by short-term profits. In the 2000 tech bubble, Nasdaq soared over 400%, only to crash by nearly 80%. It took years to recover, and many investors were wiped out in the process. Similarly, the U.S. housing market is now experiencing unsustainable price growth. According to the Case-Shiller Home Price Index, home prices increased by more than 30% in 2 years, far outpacing wage growth. This type of imbalance is a hallmark of bubbles, where asset prices detach from economic fundamentals. The bond market is also in dangerous territory, with historically low interest rates driving prices up. Investors are essentially paying to hold government debt, a phenomenon rarely seen. Grantham's concern is that this isn't just one bubble, it's multiple bubbles across asset classes, from real estate to stocks to bonds. Outside the US, Grantham notes that markets like Australia, the UK, and Japan are overpriced, but not in the extreme territory seen in the US. This highlights the importance of global diversification. Investors overly focused on US equities risk significant losses if the market corrects by the 50% Grantham predicts. The takeaway? Investors should shift their focus from chasing gains to protecting their wealth through diversification and a defensive strategy. History has shown that bubbles always burst, and those unprepared pay the steepest price.
This bubble in the US is eerily similar to the 2000 tech bubble. It's led by the NASDAQ, it's led by the specs. 2000, the specs underperformed all year and the S&P continued to climb. It is just possible that the S&P will rally to a new high. I think it is impossible that the specs will. So I think the game has started and it will play out perhaps rather like a 2000. Historically, the stock market has hated inflation. It crushes price-earnings ratios. This time, uniquely, it did not. Inflation roared through the roof, and the PEs continued to rise. Nothing like that had happened before. And we have a model that goes back to 1925, and there are two factors that determine price-earnings ratios or the price level of the market. One of them is profit margins. Of course, it loves them. And the other is inflation. Of course, it hates it. And they have worked like a charm. And in 2000, you had, for example, at the top of the market, world record profit margins and very little inflation. And today we have world record profit margins, but we have rather high inflation. The market should have dropped starting in the middle of last year had it been following the normal battle plan. It did not. The market is saying about inflation that it totally ignores it. It completely believes the Fed that it's temporary, ephemeral, etc. And it doesn't appear to be. And if that seeps into the market in the usual way, it will mercilessly depress the price-earnings ratios. And in the end, the Fed doesn't like to get on the bad side of the administration. Politically, inflation is death. The average person in the street notices it, measures it, if anything, exaggerates it. But even with that exaggeration, it's painful and politically very, very tough on the voting pattern. And therefore, the administration really wants to do everything it can to get inflation down. So it will be discreetly leaning on the Fed to do what it can.
Jeremy Grantham paints a sobering picture of the U.S. market, particularly drawing comparisons to the 2000 tech bubble. But what makes this time even more dangerous is inflation. Historically, as Grantham points out, inflation tends to crush price-to-earnings (PE) ratios, making stocks less valuable. Yet we've seen the market ignoring inflation as if it's a temporary inconvenience, which could be a massive miscalculation. To understand this, let's look at the fundamentals. In 2000, PE ratios skyrocketed as profit margins were high and inflation was low. Today, while profit margins are similarly strong, inflation is running at its highest in decades. Normally, these factors would drag stock valuations down, but so far, markets have been in denial, buoyed by hopes that inflation is a short-lived phenomenon. According to data from the Federal Reserve, U.S. inflation peaked at 7.9% in early 2022, the highest in 40 years. Yet stock prices remained inflated. Another critical element is the Fed's delicate position. As Grantham notes, inflation is politically toxic. It's a silent tax on the middle class, reducing purchasing power and causing public unrest. This is why the Biden administration has been focused on lowering inflation at all costs. And while the Fed is supposed to be independent, political pressure to curb inflation is real. For investors, the lesson is clear. This market isn't reacting the way it should. And when it does, the correction could be severe. The Fed can't keep rates low forever, and inflation is not going to disappear overnight. Grantham's analysis suggests that it's not just speculation driving this bubble. It's a fundamental mismatch between market behavior and economic reality. When that imbalance corrects, the fallout could resemble, or even surpass, the devastation of the 2000 tech crash.
There are people who spend their entire lives watching the Fed and going into the nuances of quarter points and half points, and I do not. I am confident that they will move at the stronger end of the range. I am confident they will try very hard to make sure that inflation does not become embedded. I'm also confident that that will be difficult because we're very short of labor, we're running very scarce, and wage rates will start to come through the system in the US increasingly for the next few months. That makes it very difficult to control inflation. So it will be quite a struggle, and the Fed will have to raise the rates quite a bit. If you have to own US stocks, you should own high quality stocks that are in good financial shape, because this can always spiral in to something of a financial crisis. They often do. I would emphasize, in general, though, non-US stocks. And quite a few countries, as I said, are not that bad. Emerging markets has some overhang problems. If the US goes and commodities are high priced, it's a mixed blessing at best for them. But they're very, very cheap. And in the end, cheapness usually trumps everything else. So emerging markets, some of the cheaper developed countries would be very much better idea than a massive holding of US equities. I think it is ending. I'm trying to write a paper which is basically the end of the golden era, or Goldilocks and three hungry bears. Everything has been different for the 20 years of the 21st century. The PEs average not just a little bit higher, but 50, 60% higher. Profit margins average 30, 35% higher than they had in the previous 50, 60 years. Everything seemed to work out. Corporations got a lot of political power. The taxes on capital all dropped. Tax on dividends, tax on interest rates, tax on capital gains all came down. Most of the regulatory bodies were somewhat captured by corporations, and they have had a golden era. We've never seen bigger profits. The concentration in each industry has increased, and the fangs that are remarkable companies are in their own way instant monopolies. So the monopolistic feature of our economy today, and somewhat around the world, has increased. This is very good for profits. It's not so good for growth. And the governments are beginning to twitch a bit. I don't think they're assets. I think they embed a technology that may turn out rather like the internet to be useful here, there, and everywhere. And when they are useful and when they're making money in the traditional way, then you value it like any other money-making enterprise. But while they just sit there and they go up in price because people are persuaded that they will go up in price, it's very much a question of the emperor and his clothes, I think. Bitcoin in particular, it does nothing for anybody and is superseded by a whole generation of smarter and more effective cryptocurrencies, many of which in their turn do not make money in the traditional way, and a few do. So I'm sure the idea embedded in cryptocurrency will be around perhaps forever. But I'm equally certain that most of the value today as a store of value is a hoax. It is not a store of value. Everyone can agree that the volatility is massive. It goes up and down with the high risk stocks. What is the point of a store of value that trades like a hyperspec? I mean, this is not the principle. Gold, in comparison with several thousand years of practice, has been boringly stable throughout the last couple of years. I should know, I own some.
Jeremy Grantham paints a picture of a financial world teetering on the edge, driven by speculation, corporate power, and the disillusion of traditional assets like Bitcoin. His skepticism towards Bitcoin as a store of value is rooted in its volatility, a stark contrast to the long-standing stability of gold. For those following Grantham's insights, the message is clear. The era of easy money and inflated profits is nearing its end. His cautionary tone suggests that we're standing at the brink of significant economic shifts. To bring this into perspective, let's look at history. In the last few decades, the U.S. market has enjoyed an unparalleled golden era, driven by low interest rates, deregulation, and corporate monopolies. The FAANG stocks, Facebook, Amazon, Apple, Netflix, and Google, represent this era's dominance, with profits that have soared thanks to their near monopolistic control of their industries. Yet, as Grantham highlights, these profits have come at the expense of GDP growth and economic stability. The markets today reflect the dangerous reality of what happens when profits are prioritized over sustainable growth. Grantham's reference to the Federal Reserve trying to control inflation by raising rates is a reminder that we may face a more volatile future. As inflation rises, investors must be prepared for a reality where the U.S. market may no longer provide the safety it once promised. His advice to look beyond U.S. equities and focus on emerging markets is key. These markets, despite their risks, are still undervalued and may offer opportunities when the dust settles. As we wrap up, it's worth reflecting on the broader implications of this market shift. For over 2 decades, the U.S. market has thrived under unique conditions that may not be sustainable. Grantham's perspective urges us to rethink how we approach investing, encouraging us to be cautious, diversify globally, and not be seduced by speculative trends like Bitcoin. The coming months may bring significant changes, and those who prepare wisely by balancing risk and seeking value will be better positioned to weather whatever comes next. If you found this discussion insightful, stay tuned. The next video will dive deeper into emerging markets and how they can be a strategic part of your portfolio.